Hi, I'm Tom Mihawk. Welcome back to the chapter on health, disability, and long-term care insurance. And this is the personal finance course. And we introduced why health insurance costs are so expensive in the United States, some reasons for that. And we talked about the importance of having healthcare, of having smart thinking about healthcare in your financial planning. And we talked about what constitutes a good plan. Now we're going to talk about some important health insurance terms. Deductibles are the amount payable by the insured before any expenses are reimbursed by the insurer. If you remember back to the chapter before, we talked about four things basically, categories of how to handle risk. We talked about avoiding risk, sharing risk, or reducing the risk or reducing the loss. We talked about avoiding risk, and we talked about shifting the risk. And shifting the risk is when you pay an insurance company to take on the risk. You pay a premium for that. Self-insuring, I think I might have said avoiding. Sorry, I might have said avoiding twice. I meant to say avoiding and shifting, or self-insuring is what I meant to say. Avoiding and self-insuring. And so the point is that a deductible is like self-insuring. It's self-insuring up to a limit. You're paying part of the cost of the loss. And generally speaking, the more you pay of the loss, the less your premiums are because you're paying more of the, you're paying more of the risk yourself. Co-pays are partial payment for certain costs, such as general practitioner visits or prescriptions. They're another way of lowering your premiums by having you pay part of the expense. Co-insurance, same idea, shared payment of expenses between the insured and the insurance company. And the out-of-pocket limit is the most you pay for services in a plan year. After you spend this amount on deductibles, co-payments, co-insurance, which for care and services that must generally be in the network, your healthcare plan covers 100% of the costs of covered benefits after your out-of-pocket limit. You'll become more familiar with these terms the longer you contract for healthcare insurance, but these are ones that you should know. Okay, one of the most basic types of managed care organizations is the HMO. These became available about 30 years ago. HMOs hire doctors directly to provide care. They vet the group, they select the doctors, they effectively give you a network. You used to have to look them up in a book. Now you look them up online. But you must, generally speaking, use this network of doctors and have a referral from your primary care physician for services of a specialist. This may present a constraint based on the location of your residence. If you're in a very rural area or remote area, the services you need, the preference for a referred doctor that may be out of network. I found when we had health maintenance organizations that if I had to have a surgery or some sort of procedure, I wanted to be able to talk to people, find out who they used, and use that doctor. I didn't want to have to look up in a book or online a doctor who may not be the best at what they're doing, and they're in that network because they're looking for more business potentially. Now, those of you who are healthcare professionals, I apologize, but that as an insured, that was my experience with this type of design of healthcare insurance. But the benefit of this plan, generally speaking, is for lower costs of premiums and services. By comparison, the preferred provider organization, while also a managed care organization, negotiates discounted rates with healthcare providers. It also forms a network, but has more flexibility generally than an HMO. Generally more choice of physicians. Out-of-network physicians are available and services, but there are some limitations and there might be higher co-pays and deductibles because of it. And so the charges for premiums are generally higher than for an HMO. When I had, well, let me save that story for a moment and I'll tie all this back in just a minute. So private healthcare financing. Let's start with the health savings account. Sorry for all the words, but I had to describe it in a way that you would be able to take this with you. The health savings account allows tax-deductible contributions, and they're taken out of your paycheck from week to week or biweekly or whatever. It's an attractive combination when combined with a high deductible health insurance plan. By the way, it's required to have that plan if you have an HSA, is what these are called. Especially for younger insureds, funds not used roll over to the next year, meaning if you don't go to the doctor and you put funds in this health savings account, what you don't use, you keep. You fund the plan, you manage the money, and you own it. All of the capital gains, all the growth from investments in the plan, you keep. It works especially well for young people. And by young, I mean 22 out of college to 40-ish, maybe when kids are starting to get hurt and that sort of thing. And older than that do this plan too. I have colleagues who specialize in health insurance for corporate clients, and they choose a health savings account with a high deductible plan. The story I was about to tell you in the last slide, I'll tell you now. The reason I didn't want to use this was because as I got to high school, as my children got to high school, and my son, for example, was playing sports, I didn't want him to get stitches in a lacrosse game and have me go, you know what, let's put a little gum and scotch tape on it. It'll be fine, don't worry. Or break his arm. Or my daughter in dance, injure, a ligament and say, oh, don't worry about it. We don't need to do physical therapy. We'll just do it at home. We'll work on you at home. I wanted to make sure that they got the best care. And if we needed to get a referral, we would go to the doctor that was best for them. It was easier for my wife, who was doing the primary work with that sort of thing, with the health care for my kids, and that worked for us. The Flex Spending Account, the first one here, is offered by employers, funded by you, the employee, with pre-tax contributions that accumulate up to a limit. The thing of it is, though, is if you don't use it all, you lose it. It does not roll forward. So you want to make sure you only choose an amount that you know you'll use. You use this for things that are not covered in your healthcare plan, like eyeglasses, childcare, orthodontia, those kinds of things. It's not as easy to use probably when you're younger, although if you have some of these things, and you can look this up, there are websites that specialize in helping you figure out how to spend flex spending money. But it's much more common as you become a family, have children, you have a couple of people in the family that have healthcare issues. So these are two valuable ones. You should know these. Public healthcare financing, Medicare, for those who are older, for those who are over age 65. It's a combination of publicly and privately funded care, requires some premiums to be paid, may not need it if your former employer offers a plan, and it doesn't cover all services. Most have to purchase supplemental plans to cover other expenses that are not covered by Medicare. Medicaid, by comparison, is for those who have low income. So Medicare for those over 65, Medicaid for those with low incomes. By the way, I just had this discussion recently. Sometimes they're age 26 people who are now no longer on their parents' plan have low incomes and qualify for Medicaid. So these are public healthcare financing programs. Health insurance regulation has been hotly debated. It's called the Patient Protection and Affordable Care Act. It was passed in 2010, designed to be implemented over time. Its goal was to provide more protections for consumers, make health insurance available to more and lower costs. It included provisions such as not excluding children due to pre-existing conditions. Frankly, I think it includes, you can't exclude anyone due to pre-existing conditions. Children may be covered until age 26. Now, obviously, 26-year-old is not a child, but it's a child of someone, so they can be still on their parents' health care plan. Claimants may appeal insurer coverage decisions. If they decline you for a care, you can appeal it. No lifetime or yearly limits on coverage for specific conditions. Choice of doctors must be protected. All must have minimal health insurance coverage as a means of lowering cost, meaning there are fewer uninsureds, and healthy people are also in the plan. And healthy people who choose not to be in the plan must pay an annual penalty. You have to have healthy people and less healthy or unwell people so that the healthy people can contribute to the plan and use less of the plan's benefits, so the unwell people get more of those benefits. You need a large pool to afford to pay the benefits of those that need the benefits. Health insurance marketplaces were designed also to compare and enroll in plans. And again, this is evolving. It's under debate. There are certainly aspects of it that everybody can probably agree are useful for everyone, and yet there are other aspects of it though that people can agree maybe could be implemented better, or funded better, or organized better. So it's still under debate, and it's evolving. Long-term care insurance was first introduced in the 1960s. Sales grew quickly. In the first decades, it was offered. Like health insurance, the cost of long-term care is high and increasing. 1 month in skilled care can cost $10,000 or more. I was recently talking to someone in a smaller town, an hour away from where I live near Philadelphia. It was $10,000 a month, and I would think that would be true for Philadelphia, New York, Chicago, and this is an hour away from Philadelphia. It's very expensive. Now, let's define this. Acute illnesses you recuperate from, like a broken arm. You break your arm, you go to the emergency room, they set it, and 8 weeks later you're good to go. You don't use long-term care for this. Chronic illnesses you don't recover from, and they're generally correlated with older age, like Parkinson's disease, dementia. Not always. Now, I remember, it's sad to see all of them, but I remember when my mom, who suffered from dementia the last 2 years of her life, and she was in first skilled care and then an assisted living facility, and in one of the facilities she was in, there was a young woman who'd been in an auto accident. Young meaning in her probably later 20s or so. And it's sad to see. Now, it's, again, sad to see anyone in assisted living and suffering from a chronic illness. But long-term care insurance is used for this. Many will experience long-term care needs during lifetime. Many more. There are many statistics about this, more than I could put on this one slide. Long-term care insurance designs are traditional, the way it's always been, where you pay a premium. The challenge here is you could pay a premium, and if you don't use the long-term care benefit, you lose what you've paid in premiums. The newer style, last 15 years or so, is called the hybrid or the linked style. You pay a premium, and you can either receive a long-term care benefit, receive a death benefit, or get some or all of your premiums back. You won't miss out on a benefit there. Either you're going to pass away and get a death benefit, or you're going to have a long-term care need and get a benefit, a long-term care benefit, or you can get some or all of your premiums back. And this has become a popular product. You generally design long-term care with a daily amount, and your goal is to pay less in premiums than you get in benefit over time, and have flexibility like described with these hybrid or linked products. Those who've had parents or loved ones who've suffered with chronic illnesses and had long-term care needs are the people who look at this most often, but everyone should really look at this. Disability insurance protects your ability to earn income. For many, this is their most valuable asset, their ability to earn income. Disability is more likely than death at any age, the industry would tell you. It provides regular income, usually about 65% of your salary, which, surprise, surprise, is approximately your pre-disability income after taxes. The disability industry does not want to give you an incentive to not work. So they want to pay you an amount, if you pay premiums, pay you an amount that gives you what you would generally get after taxes. The definition of disability is very important. Own occupation, that pays a benefit if you can't do your regular job. It's generally more expensive. And a non-own occupation definition, which pays a benefit only if you can't do any job. It's less expensive. Doctors, attorneys do own occupation, meaning if I can't do surgery but I could teach, I'm going to make less money, so I earn a benefit. A CEO or a national sales manager who can't fly anymore for a disability reason, CEO but might be able to be a national sales manager, they might buy a non-own occupation definition because it's less expensive, and being a national sales manager, you might earn as much as the CEO does. So it's important to know the difference between the two. Non-cancelable and guaranteed renewable, the policy should be. Benefits usually go to age 65. They can be age 70, age 67, sometimes maybe 70. There's usually a wait period or elimination period, 30, 60, 90 days, sometimes 180. The longer you wait, the less premium you pay. It's basically a longer period of effectively self-insurance. And the amount and the duration of the benefit matter as you consider the policy. Employers often offer disability insurance. You may purchase it privately to increase your coverage over what your employer gives you, or if your employer doesn't give it to you, or you're self-employed, you own your own company, you can own private disability insurance and purchase it through an advisor. When you're disabled, Social Security offers disability for a total disability lasting more than 12 months. And you must be unable to do any work. Workers' compensation applies if an accident or illness occurs at your place of work or was caused by your occupation. So, wrapping it up, how do we reduce our healthcare costs? Focus on prevention, stay fit, eat a healthy diet, track your health measures and keep in the healthy range. Keep your weight in a healthy range. Avoid smoking or drinking to excess. Get sufficient exercise, sufficient sleep and relaxation. I used to think best to go to bed late, get up early. That's a way to get things done. Well, it is for a while, but sleep is a critical way to rejuvenate and to stay healthy. Drive carefully. Watch for accident and fire hazards in your home. Participate in your flex spending plan, a health savings account with a high deductible plan, health plan, if it works for you. And there's a bias. If you're younger, it tends to work better. Keep good records and choose the best healthcare plan for yourself. Know for yourself if value is added by having dental, vision, or other plans. Add it up. If it's $30 a month, $360 a year for your dental plan, you look at last year, the year before's expenses, and you spent $700, well, it's worthwhile to get your dental plan. Or if the same with your vision plan. If you get frames every 2 years, contact lenses 4 times a year, and the plan costs $20 a month and you're normally spending $500, get the plan. It's worth it. Do the analysis, change plans when it's to your advantage, use less expensive generic, mail order, or online sources for long-term drugs that you use. This has been the chapter on health, disability, and long-term care insurance. I'm Tom Mihawk. You can find me at tommihawk.com and at YouTube. Thanks for watching this segment 2 of this chapter, and I'll see you in the next chapter. Thank you.